Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, December 29th, 2023. If you asked me a year ago how I thought the stock market would perform in 2023, I would have said, I believe the stock market is more likely to go up than down in 2023, especially during the second half of this year, assuming the Fed is done raising interest rates by then. I know that because that is what I said at the end of last year. And here's, by the way, that article from a year ago, and down here at the bottom is in fact where I made that statement. And in fact, as you see down here, I went on to note the S&P 500 index could rise 20% next year and still finish the year below where it started this year. I finished that thought by advising, as we head into 2023, it is time to stop thinking pessimistically and take a more balanced view of how it may turn out. I am pleased to report that my optimism for 2023 was warranted. In fact, the S&P 500 index rose more than 20% to reach an all-time high this week, as did the NASDAQ Composite Index and Dow Jones Industrial Average. In short, the stock market is back to where it was 2 years ago before the Fed began raising interest rates. Now here's a chart of the S&P 500 year to date, and you can see the big jump over the past 2 months. If we go back 2 years though, you go way over here to the left, it's just now cresting above where it was then. So we've gone full circle basically since then. However, the bond market is in a very different place now than it was then. 2 years ago, the yield on the 10-year Treasury note was well below 2%. Now it is nearly twice that amount after peaking near 5% 2 months ago. As a result, bond prices are lower now than they've been in a long time. So here's the yield on the 10-year Treasury note over the past 2 years. You can see way over here on the left, we're getting a value of 1.5 to 1.8. You can see it rising all the way up to almost 5%, 4.996 on October 16th. So it's pulled back since then, but still roughly twice what it was 2 years ago. If the Fed starts cutting interest rates in 2024, as many analysts believe it will, then bond prices will go up as yields go down. As that happens, some income investors may once again feel compelled to abandon the bond market in favor of stocks to obtain the returns they need to make ends meet. At the same time, lower interest rates will decrease borrowing costs for businesses and consumers. That should widen operating margins while increasing sales, resulting in bigger profits. It is the increasing likelihood of that scenario that has been driving the stock market higher over the past 2 months. Given the magnitude of the stock market's recent rally, it is fair to ask if it's gotten ahead of itself. Is there too much optimism priced in the stocks now, or are they finally back to where they should have been all along? To answer that question, it helps to look at some numbers. According to Yardeni Research, estimated earnings per share for the S&P 500 in 2024 is $250, and I've included a link to this page here, and if you look under the year 2024, you see a top line figure of 250 versus 225 in 2023. Now, the consensus Wall Street estimate's a little lower, 245, but I found Dr. Yardeni to be a very accurate prognosticator of corporate earnings, so I tend to go with his numbers. So if you multiply that $250 per share earnings times a multiple of 50, which is its recent average for forward earnings, that results in an index value of 5,000. Now this morning, the index opened a little below 4,800. So not a huge improvement over that, but a positive direction. However, if interest rates do come down in 2024, then the forward earnings multiple will most likely go up. If we apply a multiple of 24, which is on the high end of its recent average, that results in an index value of 6,000. Now, of course, there's a huge difference between 5,000 and 6,000. My guess is the index will end 2024 around the midway point of those two values, or 5,500. That would equate to a gain of roughly 15% from where the index is today. But if interest rates remain flat next year, I'd expect the stock market to deliver a positive but modest return. That's this week's PF Weekly Update, and I look forward to talking to you another week, and have a happy and safe New Year's weekend. Thank you.